Hello and welcome to the channel. As always, please remember that this information is for educational purposes only and does not constitute investment advice. You always gotta do your own due diligence. And if you're copy trading, you're an absolute moron and you deserve to lose all your money. So, today I'm gonna talk about a stock called RDNT, ticker RDNT. And I'm gonna pull up here different charts that I follow. So first thing that we see when we look at this stock is that it's been ranging for quite a while, since about April, when it reached the 27 mark. It's been ranging ever since between that level and 32, 35, somewhere around that, which is the high of the year. So slow downhill here to go back up very quickly. What has it done in previous years? Well, it's been growing quite steadily. But now we're going to focus over the next, say, 3 to 6 months. What's going to happen with it? Well, first thing that we see, we got a cross over here of the 50-day moving average. We can see that signal this downtrend here quite correctly, but that doesn't mean that that's the end all be all, because as you can see, the stock bounced back quite quickly. So what has happened here? Well, they reported recently the results, and even though they were good, they beat both on revenue and EPS, the stock didn't really move. So we have to ask ourselves if the market was expecting more. And I think that's likely the case, because if you look at this company, have a look at the signal around here. This is the next 12 months PE, right? Is currently trading at 79 times earnings. That's next year's earnings. So you have to really want to see this company absolutely killing it if you are willing to pay for that valuation, because it becomes even more crazy if we look at the last 12 months PE, when it becomes a valuation of almost 500 times. Okay, now you could argue that the current high multiple is justified because the earnings have been growing quite a bit, and the earnings for next year are also forecasted to grow at 34.7%. So they are expecting to bring significant earnings growth into the company. So if that doesn't happen, well, we could see the stock falling rapidly, as we did see a few weeks ago. So first of all, one of the things that caught my attention about this company, let's look at the financials. Financials don't look great. We got revenues, yeah, going along nicely. Gross profit's gotten better, improved margins, better EBITDA, okay. 2021 negative year of net income noted. Price to earnings, as you can see, completely out of the chart. It wasn't the case before, when it was trading at a more reasonable valuations. And then here's what really got my attention. CapEx is tremendous for this company. So you have a company that is bringing in 2020 cash from operations of 233 million and spending 94 million out of that in CapEx. Same thing with the last 12 months, bringing 195 and spending 157. So that's quite significant, in my opinion. Then something I noticed is one of their competitors got downgraded by S&P, and that was not just a downgrade of a notch. It was downgraded to speculative grade by S&P. I'm opening this window here for you guys to see it. But what's interesting to me about this article is that the factors at which it alludes to are definitely relevant to RDNT. So here's talking about labor and supply chain challenges, delays in recognizing synergies from a previous merger. Definitely the case here because RDNT has been acquiring businesses as well, and relatively soft patient volumes. So combined, those factors have led to weaker than expected margins and limited revenue growth. Okay, and at the same time, you have this company saying that next year they're gonna grow earnings by 40%. So what can happen here? Well, if those expectations are not met or they simply fall short, we could actually see investor appetite fading away relatively quickly, right? The company has appeared in earnings calls talking about their financial position, and what they were saying is that they are in a pretty good position in terms of their financials. But at the same time, they also issued new stock, which was not received well by the investors. When that happened, we saw the stock going down quite a bit. I think that was about June. Yeah, somewhere around here. Yeah. And so you see what the stock did there, right? So if they are doing that well, why are they issuing new stock? Because that float that they issued is about 12% of the market cap. It's not an insignificant number. So all those things are something to bear in mind. No shareholder or investor wants to be diluted. Aside from that, well, how is the business doing? They have a lot of work to do in terms of what they bring as additional value to their customers. But the reality is that they don't seem to be doing that well at their existing operation. So if you go into Yelp, for example, you can see that there's numerous reviews about the company with dissatisfied customers, several complaints in the Better Business Bureau. And at the same time, it seems that a good part of the strategy is further acquisitions and AI expansion. So you have to get all those things right to sustain or even maintain, to maintain or even improve that picture. Because again, that valuation is just very, very demanding. So we're gonna ask ourselves how much higher can it go? So here's something that we can do. I'm gonna keep this one on my watch list for now, but you definitely can structure some calendar spreads with puts if you want to go. I hope that you enjoyed the video and see you next time.